Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Friday, May 24th, 2024, and this is Blockhead Traders Weekly. In this week's episode, I'm going to do a special episode on the earnings of NVIDIA. This is the big green monster, and I took a crack at this thing and wrestled it with a strangle, and I want to reflect back on that and take you through the setup, the trade, and the exit plan. But before we hop to that, I want to give a shout out to the Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/Sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Also, this is available in an audio-only format wherever you get your podcasts. So like it there, subscribe, and if you can't find it, let us know and we will get it there. But let's hop to this week's content of NVIDIA and strangling the monster. I always keep my eye out for earnings trades because, as I mentioned before many times on this show, earnings are one of those binary events where there's a lot of price acceleration and a lot of spot volatility that will basically evaporate once the earnings announcement is out there, because the volatility kind of pumps up leading into earnings because there's a lot of uncertainty over what will the company report. Is this going to go up? Is it going to go down? And there's just a lot of really uncertainty. So a lot of the options premium really gets jacked up because people go to the options to look to buy insurance on the shares that they own, or speculation on the whether or not it's going to go up or down. And all of that options activity drives a lot of volatility. And so what I love to do is I love to go into those very volatile names, because a lot of times volatility is overstated, which means basically it gets pumped up more than the stock actually moves. And so I like to kind of look for those cases where there is an overinflation of volatility, and I play what's basically a mean reversion play that says, you know what, I'm going to bet that this is a little bit too much volatility, so I'm going to go ahead and sell the volatility now and wait for the earnings announcement. I'm going to ride that risk of where that stock's going to go through earnings. And once the earnings announcement is out, that volatility will really collapse because there's not a lot of unknown left. Everything's been publicly released. All the traders react to it. And then you can buy back those positions to close them out at usually a significant discount to what you sold them for. And you're basically profiting on that arbitrage opportunity of the price prior to earnings and the price after earnings. Now, keep in mind, this is not a risk-free thing. You are taking on the risk of where that stock is going to go during earnings. And a strangle is what's known as when you play both the top and the bottom side of the earnings. And so it basically means you're going to sell an option on the put side and sell an option on the call side. So you're effectively saying, hey, I don't think this stock is going to move more than X% wherever you place your strikes. And if it stays between those bounds, that's where the volatility collapses. Both your options stay out of the money. You do not get assigned, and you can buy them back and close them out, usually for a significant profit. So heading into earnings, when I look at screeners, the higher the stock price is means the higher the price per share, the more premium there is, and then the more volatility, the more premium there is. And on my screener, NVIDIA really showed up as something that was kind of up there with when it comes to volatility. Earnings going up. Historically, there's been a lot of volatility contraction around these earnings when NVIDIA comes out. So let's take a look at the chart historically. And the part you're going to want to focus on here is this light blue chart. And when what you got here is on the top, you'll get these blue markers here, blue and red. This is an earnings announcement. This is an earnings announcement, an earnings announcement. And what you see here is this pump in volatility and then this cliff. Okay, then it kind of wanders around down here. We got a little bit of, it didn't really pump up too much for this earnings, but you got a cliff after it. Okay, heading into this earnings, we got a pump, and then a cliff. And so basically it's this cliff that I like to see. And then I like to see heading into the earnings, where are we at? Are we at an extended range? And I really like to see things above 50%. And then the closer to 100% you get, the more I like it. A sweet spot for me is usually like a 65 to 75% volatility. In this case, you can see right here is the most recent earnings that was coming up, and it wasn't as elevated as in the past, but I was really kind of anticipating that cliff afterwards. And part of my other thesis here is AI has really been pumped up, and I was kind of banking on at least significant profit taking on a beat and a rise to the upside. You know, the other thing I was basically considering is, okay, if it crashes to the downside, am I willing to hold NVIDIA? And the AI play is something that I do think long term will be around for years to come. Now, I do think it is kind of inflated right now, so I don't really want to be investing in NVIDIA. But playing these earnings swings and this volatility contraction was definitely in my realm of comfort. Now, this bottom thing that looks kind of red and green, this is an indicator I made myself through some scripts. And anytime this is green, that basically green means go. And NVIDIA was in that green range prior to earnings. And so this was really checking out on all the boxes as far as how much premium was going to be there, what was the probability of volatility collapse after earnings, and how much was the expected move that we could see going into earnings. And so you might say, well, how the heck do you know what the expected move is going to be? Because you know, it's unknown. It could go. I mean, NVIDIA has had a couple of earnings announcements where it's popping 20 and 30% the day after earnings, which is pretty wild for a stock that is a giant tech stock, a blue chip stock. You don't normally see a lot of those things really ramping up. So let me just show you where you can get in any of your brokerage kind of an idea of what the expected move might be. Now, this is already over, but what I'm going to show you is still applicable no matter what type of option chain you're looking at. So whatever type of option chain you look at, every single chain is going to have a different expiration. And so right here we got, you know, the ones that expire today, ones that expire next week, the week after, the monthlies. But your interface will have a plus minus number and then a percentage number. The percentage number, this is the volatility percent. And the number in parentheses, you see a plus minus. This is the expected move by expiration from that point in time in the future. And so you really can't see it here because we're past earnings. But what we were looking at for NVIDIA was a plus or minus about 8% move. So the option chain that expired today, May 24th, when I looked at this on May 21st, was kind of predicting an 8% up, 8% down move. And I usually like to play what's known as a 16 delta strangle. So I'll go, and if I'm playing both sides in a strangle, I'll usually start at around a 15 delta. I might bring that up to a 20 delta depending on the expected move, depending on the premium. But in the case of NVIDIA, I stuck to a 16 delta. And so that's roughly a 1 standard deviation move statistically from where the options are trading at the time of entry. Now, what I'm going to do is I'm going to bring up a chart of NVIDIA. Now, I've blown this chart up to 5-minute candles because remember, I entered this trade on the 21st. The earnings announcement was on the 22nd, and my goal was to basically close the trade out on the 23rd. So the day after earnings, while the volatility comes out. And so let me go ahead and pull up this chart of my trade that I put out there. And what we've got here is I've got this red bar at the top and this red bar at the bottom. These are where my strikes were. They were $860 put. So basically I was saying, hey, the stock's going to stay above $860, and $1,050 was where I put the stock on the top side. And to give you a rough idea, this range from my 860 put all the way to the 1050 call was about a 22% range. And I entered when it was roughly almost right in the middle of this range because of the 16 delta, I'm going 16 delta to the top and 16 delta to the bottom. And so statistically, I'm looking at basically an equidistant move to the top and to the bottom. Now, sometimes with a lot of skew, a 16 delta will be a lot further in one direction than the other. But NVIDIA going into this was pretty even skew on the call and the put side. Now, normally you'll see a lot more skew on the put side. So there's a lot more premium on the put side, which means you can go a lot deeper or a lot farther, a lot more out of the money on the put side and still get a decent amount of premium. If you have something like a GameStop or something that's really rocketing to the moon, you'll get what's known as call skew. And that's very rare. A lot of times you'll get that only when there's a lot of speculation and people just really buying the bejeezers out of the calls. More naturally, options are used for basically protecting someone's investment. And so that's basically an insurance policy. So they buy a lot more puts to protect them to the downside versus speculation on the upside of calls. So when I got into this, it was trading around $950. And so I was looking at a potential 11% up move and 11% down for earnings. And I was really liking that. Now, like I said, I'm okay to buy the NVIDIA shares. If we got down to 860, it'd be a heck of a discount. I really didn't want to be short the shares, so I really didn't want to go through that call side strike. In fact, of everything, this was the most nervous of the position because this is a significantly large product. And it's one of the larger ones that I've ever traded. Now, I've traded bigger products on futures, but the way they do margins and the way that those things move, I'm more comfortable with that. This is in the equity world. And so basically, remember, one contract is representing 100 shares of this. So if I was to get my call side breached and it just went, up 30%, I am on the hook to buying 100 shares of NVIDIA on the open market so I can sell them to somebody for $1,050. And so there's a good bit of risk to the upside. And I was a little bit nervous kind of going into this, but I had come to grips with that and said, no, this is what I'm okay with. So let's do it. And so you can see right here on this chart, heading into earnings were after the bell here on the 22nd, this giant candle, which was this huge move down to like 900 almost. And then all the way up to 1,000 was right after the earnings hit the wire. And you can see that then they kind of built in the analyst call. We kind of pumped up here. The blue shading, this is the after hours in the evening, and then this yellow is the pre-market the following day. So this is hanging out around 1,020. So I was feeling pretty good just before market open. At 10:20, I was $30 out of the money with the 1050 strike. But I was a little bit nervous because NVIDIA really has a tendency to run, and there's a tendency for a lot of retail investors to pile in, and that's probably going to happen when the market opens. So I really wasn't sure. I was very confident that I was not going to sell immediately on the market open. I was expecting a big ramp up and then a quick pullback of people taking profit. And it was on that pullback that I wasn't really sure if we were going to, bounce off of something and just keep climbing higher, or if we were going to break through and fall back down. Now, ideally for my premium, I want to break through and fall back down. But this was not a stock that I wanted to hang around with to see what happened. And so what I actually ended up doing was about 20 minutes into the open, I had an order to close that hit on this pullback. And I had set that order because I wasn't sure what I was going to do and I didn't want time to get away from me. So I wanted a standing order out there. The order ended up filling at $5.91 buy to close. I think I had it set at like $5.95 or something like that. So I got a better price fill, which means I paid $591 to close the position that I had opened just one day earlier. And that's pretty impressive considering how close I was to that strike. So I'll switch over here a little bit to show you on the option or the actual play that I made where everything was statistically. So when I sold the Strangle, the volatility for that week's option, so the options that expired this week, the week of the earnings, was 120%. Now you saw me just a bit ago pull up that option chain with most subsequent weeks from this week trading at 30, 40%. And so you can see 120%, that is significant volatility pump up in there. So I'm playing this contraction. It was $950 was the underlying price. Once the earnings were out and approximately the time I sold, it was down to about 50% volatility on this week's expiration, 50 to 60%. You saw that it ended up closing the week around 66% volatility. One thing I have found is a lot of times that volatility will kind of collapse a little bit, like usually gets cut in half, go down by 60, 70%, and then it stalls. So the volatility doesn't really go to zero per se. You just get this quick pop. As soon as that's over, that's done. And the only thing that you're making money off of is the movement in price, no longer that volatility contraction. That comes out usually within, 10 to 20 minutes of the market open. So post earnings, this thing jumped up to about 1020, 1030, 1020 pre-market hours, and then we were kind of creeping up at close the day after at 1030. I closed out at 950 something or other after earnings on that pullback. And what you can see here is when I sold that strangle, that 860 put, 1050 call, I collected $17.87 for that. That represents 100 shares. And so I effectively collected $1,787. So good chunk of premium. And when I'm closing that thing out for $591, I get to pocket that difference. And so that's where I got about $1,200 or 12% return on my capital. It did require about $10,000 to $11,000 of buying power. And you take that premium that you get to keep, divided by that, and that's basically your return on the capital that you couldn't use for other purposes because it was being consumed by that buying power. So should I have sold when I did? Should I have hung on a little bit more? Let's go back to the chart of where we actually moved to. And to kind of answer that. And personally, I'm happy I sold when I did. My target for a lot of these earnings trades are once you hit that 50% premium mark, ring the register, go home, play another day. Don't try to win that last, 20%, that last 10%, whatever that last little eke bit is. It's not worth it, in my opinion, for the risk of the price movement. And this particular trade, I would have gotten very, very sad if I had stayed in it. Because basically shortly after the market opened, yes, it did fall a little bit more from where I closed out, but it built with buying momentum for the balance of the day. In fact, it even broke my strike during the day, going as high as about 1060. Now, this would have been a tremendous blow to my buying power in my account. And this is where the call side can get really crazy and really dangerous. And I don't recommend really selling naked calls like this for any beginners. Really do it with small things first, really understand what the risk is so you know what you're doing, because these things really can get away from you if you're not paying attention or you're not really understanding what could happen. So what I mean by that is, remember, my strike was at 1050, this thing got to 1060. So in that, maybe 20 minutes of price movement there, that basically increased $10 of intrinsic value for this 100 shares. So the amount of buying power expansion, that's $1,000 that this thing was going to move in 20 minutes of buying power. Now, the buying power, because it also is the risk of then having to purchase those shares, would have extended beyond $1,000. So whether you built up $1,000 of intrinsic value, your buying power likely would have expanded, probably around $2,000 to $3,000 of buying power, which, that's a 20 to 30% move in your buying power expansion simply for this movement. And if you saw this, you really would have been thinking to yourself, oh, shoot, I totally missed it. Now, the price action here said it failed and then kind of came back down significantly, back down to that 1020 mark. So yeah, you could have gotten a lot of that back and more, because you would have also had more volatility and time premium decay on this. Mostly time premium, volatility would have already been out. But that's just something that I personally am not comfortable with, especially on such a large underlying stock representing 100 shares with $10 movement into the money like that. And knowing that NVIDIA also historically has racked up 20, 30, 35% moves after earnings, I would have been very, very nervous had I stayed in this trade. So if I ask myself, is this a trade that you're happy with? Would you do it again? A lot of times you can kind of really skew that answer depending on whether the trade was a success or a failure. I try to go back and reflect on the objective measurements that led me to entering that trade. And that really is, did my design pattern or did the pattern of history repeat itself? Did it rhyme? It never actually repeats itself. It often rhymes. Famous quote by Mark Twain. And you can see, sure enough, earnings, vol collapse. Earnings, vol collapse. Exactly what I was hoping was going to happen. And that's exactly what I was trading, was that volatility contraction. I was selling the volatility, shorting volatility to buy it back after earnings. This thing has had that volatility clef in all of the last earnings for the last year. It continued with this one. So it was really the perfect setup, because the volatility was extended to the point where I felt comfortable taking strikes outside the expected move, because I thought there was a very high probability that NVIDIA would exceed the expected move, because that's another measurement historically that NVIDIA has done, is it has exceeded the expected move of its earnings. And sure enough, it exceeded it here. The expected move, I believe, was closer to about an 8% expected move. And you saw on that chart, at the end of the week, we exceeded that 11% move that I had priced into my strikes. So had I not gotten out and ridden that thing all the way to expiration, I would have expired in the money. Now, I wouldn't have ever really let that expire in the money. I would have either been early assigned, or I would have rolled that forward to next week. But I am not interested in trying to decide when NVIDIA is going to go back down. So shorting it, or basically having that short call, doesn't make a lot of sense to the strategy and belief that I have in NVIDIA as it's slowly climbing higher. That's not amount of risk that I want to keep on the table. So I was very happy to close it out when I did, collect the premium that I did collect, and I'll go back to looking for earnings trades or other trades that have this extended volatility, this green chart where, the historical volatility is above that, 60% of the time over the past year. And that's really the bread and butter that I like to trade. Well, that brings us to the end of this week's episode. A little bit of a short one on strangling the monster of NVIDIA, where, hey, the metrics and the objective criteria that I have in my filtering really lined up. We had extended volatility. We were going into earnings. We had a high probability of a move that was going to stay within a one standard deviation, or at least close enough that I could capture that volatility contraction before we breached the strike to the top side or the bottom side. So I was really indifferent whether or not NVIDIA was going to beat earnings or fall short of earnings or ramp up or ramp down. All I was playing was that it was going to stay within a one standard deviation move long enough for me to catch and capture that volatility contraction that comes out. As soon as that volatility contraction is on the table, I cash out my trade, I book the profit in the bank, and I go to looking to the next trade that fits that and look for that next setup. To me, it's really important to find the trades that you like to do and the setups that make a lot of sense for you. Take those setups, back test them, watch them on paper trading, try to set them up before you put real money forward, and then put real money on them, and limit your real money to the position size that's comfortable for you, your portfolio, your risk tolerance, and really settle into that style. Because once you really develop those metrics that you're comfortable with and the parameters and entry stuff that fit your style, fit your strategy, it really can be a low-key thing to kind of go in there, survey, fire off a couple of trades, regroup, wait, look again. And it doesn't have to be this constant, watching every tick, every symbol, up, down, buy, sell. What do I do now? You really can kind of put it out there, collect the premium, or whatever your strategy is. It doesn't have to be collecting premium. And it becomes a much more relaxed operation. And it's a fun way, in my opinion, to slowly build wealth. Hopefully you are out there finding the things that are interesting for you, and you find trades that make work for your strategy, your style. Good luck out there. And remember, think outside the block.